Two brothers applied for mortgages in the same month on homes 3 streets apart in the same city. Same lender, same loan amount, similar down payments. The older brother walked out with a 5.6% interest rate on a 30-year mortgage. The younger brother walked out with a 7.3% rate on the same term. Same week, same institution, same city. The gap between those two numbers does not feel dramatic when you say it out loud. When you run it through a mortgage calculator, it produces a number that stops you mid-breath. Over 30 years on a $340,000 loan, the difference between 5.6% and 7.3% in total interest paid is $127,000. $127,000 separated those two brothers, not by income, not by financial responsibility, not by any meaningful difference in their ability to repay, by a 3-digit number that one of them understood and one of them did not. The younger brother spent the next 6 months trying to figure out what his brother knew that he did not. What he found was not a secret in the conventional sense. It was not hidden in a vault somewhere. It was built directly into the credit scoring system, operating in plain view, understood completely by every mortgage broker, credit repair company, and bank that profits from keeping it obscure. My name is Zick. And what the younger brother found, what Patricia found when she walked back into a mortgage office 93 days after being quoted a brutal rate and left with a score 140 points higher, is exactly what this conversation is about. Not a hack, not a scheme. A legitimate feature of how credit scores are actually calculated is that the financial industry has every incentive to keep consumers from discovering. By the time this is over, you will understand exactly how the system works, why the conventional advice about building credit slowly serves lenders better than it serves you, and the specific steps available to you right now to use the system's own rules in your favor. Before the strategies, you need to understand what a credit score actually is, because the conventional understanding of it produces the wrong conclusions about how to improve it. A credit score is not a character assessment. It is not a measure of your financial responsibility in any holistic sense. It is a statistical prediction, a number generated by an algorithm estimating the probability you will default on a debt within the next 24 months based on patterns in your credit file compared against millions of other consumers. It is a calculation. Calculations follow rules. Rules, once understood, can be worked with intentionally rather than simply endured passively. The calculation weighs 5 factors. Payment history, whether you have paid accounts on time accounts for approximately 35% of your score. Credit utilization, the percentage of available credit currently in use accounts for approximately 30%. Length of credit history accounts for roughly 15%. Credit mix and new inquiries account for the remaining 20% between them. The conventional advice addresses payment history clearly. Pay on time every time. It addresses utilization broadly. Keep balances low. But the advice on credit history length almost always says the same thing. Wait. Your accounts age over time and your score improves with them. Be patient. There is nothing to be done about it except let time pass. That advice is where the profitable misconception lives. And the profitable misconception is the entire foundation of what follows. The first and most powerful strategy involves something called authorized user status, and it exploits the single largest gap between what the credit system tells consumers and what it actually does. Here is the mechanism. When you are added as an authorized user on another person's credit card account, that account's complete history transfers to your credit report. Its age, its payment record, its credit limit, its utilization pattern, all of it appears on your file as though you had been part of the account from its first day. Read that again because the implication is significant. If your father has a credit card he opened 19 years ago with a spotless payment record and consistently low utilization, and he adds you as an authorized user on that account today, a 19-year-old account with perfect history appears on your credit report within 1 to 2 billing cycles. Your average account age does not grow slowly over years. It recalculates immediately to incorporate the full age of that account. This is what Patricia discovered. Two of her own accounts, both under 3 years old, gave her a thin credit file that the algorithm read as unestablished. Her mother had 3 credit cards with a combined history exceeding 40 years, utilization consistently under 5%, and no missed payments. Patricia was added as an authorized user on all 3. Within 60 days, her credit file reflected accounts with an average age that transformed how the algorithm read her profile. Her score moved 140 points. The loan officer asked if she had submitted the wrong social security number. She had not. She had simply used a feature the credit system was designed to include. This is not a glitch. The authorized user mechanism was built intentionally into credit scoring models to allow one spouse to help another build credit when finances were managed under a single name. It has been maintained and extended beyond that original purpose because it reflects a genuine financial relationship and because modifying it would create problems elsewhere in the system. FICO and VantageScore both incorporate authorized user accounts explicitly. The practice is entirely legal and officially recognized by all 3 major credit bureaus. Banks understand this mechanism completely. Mortgage brokers use it for clients before application. Credit repair companies charge hundreds of dollars to facilitate access to it. The reason most consumers never encounter it organically is simple. Every month a consumer spends with a 680 score instead of a 780 score is a month they spend paying higher interest rates, generating more revenue for the institutions managing their debt. There is no profit in helping someone escape that position quickly. For the authorized user strategy to work correctly, the account you are added to must meet specific criteria. The payment history must be clean, any missed payments on the account import, alongside the positive history and can damage rather than help. Utilization must be low, ideally under 10%. The account must be genuinely old accounts under 5 years, provide minimal credit history benefit if you already have accounts of similar age. The credit limit should be meaningfully higher than the current balance. The primary account holder does not need to give you a physical card or account access. The addition is strategic and the credit history transfers regardless of whether you ever use the account. Most major issuers, Chase, American Express, Bank of America, Capital One, Discover, report authorized user accounts to all 3 bureaus. Verify this before proceeding. Some smaller institutions do not, which means the history never appears on your report, regardless of being added. The second strategy involves the utilization calculation and the timing gap most people never discover. Utilization is the percentage of your available credit you are currently using. The algorithm reads lower utilization as a signal of financial stability. The conventional guidance says keep utilization under 30%. More precise guidance says under 10%. The actual optimal range for maximum score impact is between 1% and 3%. 0 is not optimal. The algorithm wants to see that you use credit, just very little of it at any given measurement point. Here is what most people do not know. Utilization is calculated based on the balance reported to the credit bureaus, which is typically your balance on the statement closing date, not your payment due date. These are different days, often separated by 2 to 3 weeks. Most people believe that paying their credit card in full every month means the algorithm sees them carrying no balance. This is frequently wrong. If you charge $2,400 during the month on a card with a $3,500 limit, and that $2,400 is your balance when the statement closes, the Bureau receives a report showing 68% utilization, regardless of whether you pay the full amount before the due date. You are paying in full. You are not paying interest. You are behaving responsibly by every measure. And the algorithm is recording 68% utilization and reducing your score accordingly every single month. The correction requires only a calendar reminder. Find your statement closing date. It appears on every credit card statement and is typically available in your account settings. Pay your balance down to near 0 before that date, not the payment due date. The balance that closes on the statement is the balance reported to bureaus. If you pay before closing, the statement reflects a near zero balance, and your reported utilization drops immediately. The change appears on your credit report within a single billing cycle. This costs nothing, requires no new accounts, changes in spending behavior. People who implement it consistently see score improvements of 20 to 45 points within 60 days purely from adjusting which day of the month a payment is sent. The third strategy involves credit limit increases and the specific reason most people never request them. Utilization is a ratio. The numerator is your balance, the denominator is your total available credit. Most people focused on utilization attack exclusively the numerator paying down balances. They ignore the denominator entirely. But a higher credit limit on the same balance produces lower utilization with no change in spending. $2,000 on a $4,000 limit is 50% utilization. $2,000 on a $10,000 limit is 20% utilization. Same debt, dramatically different score impact. Many credit card issuers process limit increase requests through a soft inquiry rather than a hard inquiry. A soft inquiry does not affect your score. A hard inquiry reduces it temporarily by 5 to 10 points. American Express is particularly known for soft inquiry increases available directly through their app. The process takes minutes. Approvals can be immediate. Your limit increases and your utilization ratio improves the moment the change is reflected. The credit limit increases on every card you hold every 6 to 12 months. Each approved increase improves your utilization ratio across your entire profile without requiring you to change a single spending behavior. Someone who begins this practice with $11,000 in total available credit can accumulate $40,000 or more in available credit over 3 to 4 years through periodic requests alone, and the utilization improvement compounds with each increase. If these strategies are showing you a version of the credit system you have never seen before, take 2 seconds and hit the like button. It genuinely helps the channel and I appreciate every one. The fourth strategy is rapid rescoring, and it exists specifically for people in the middle of a mortgage application. Normal credit profile changes take 1 to 2 billing cycles to appear on your report. When you are actively in a mortgage application, that timeline can mean missing a rate lock or watching an approval window close. Rapid rescoring compresses the update timeline from weeks to days. Here is how it works. Your mortgage lender, not you directly, because this service is not available to consumers independently, can submit documentation to credit bureaus requesting immediate reflection of specific changes. Pay off a credit card balance and provide the confirmation to your lender. The updated zero balance can appear on your report within 72 hours. Become an authorized user on a family member's account, and the lender can request expedited reporting. Score improvements that would normally take 2 billing cycles can appear before final underwriting. The implication for timing is significant. The optimal window for executing credit improvement strategies is not 6 months before a mortgage application, when the improvements may fade or be offset by subsequent changes. It is immediately before and during the active application, where rapid rescoring can reflect the improvements in real time while the rate is still being negotiated. Ask your lender explicitly about rapid rescoring availability before accepting any quoted rate as final. The fifth strategy involves account management, specifically understanding which accounts protect your score and which silently damage it. Conventional wisdom says never close a credit account because doing so reduces available credit and potentially shortens average account age. This guidance is partially correct and consistently misapplied. What actually matters is which specific accounts you close. Closing your oldest account removes the anchor for your credit history length and is almost always damaging. Closing a 2-year-old store card opened for a one-time discount that carries an annual fee and contributes minimally to available credit may have no meaningful impact or could actually improve your average account age by removing a newer account from the calculation. The strategic approach requires reviewing every account on your report with 3 questions. How old is this account, and what does its removal do to my average account age and oldest account status? What does this account contribute to my total available credit and therefore my utilization ratio? Does this account carry an annual fee that is not justified by the benefit it provides? Accounts worth protecting permanently are your oldest card regardless of usage, and any high-limit card that significantly reduces your utilization ratio. Accounts worth evaluating for closure are recent store cards with low limits, annual fees without value, and accounts that are newer than your average and therefore pulling your average account age downward. Here is the action plan organized by where you currently stand. If your score is below 650, the authorized user strategy carries the largest single potential impact. This week, identify 1 to 3 family members with credit cards older than 10 years, payment histories without any missed payments, and utilization consistently below 10%. Have a direct conversation about being added as an authorized user. The process takes 10 minutes for the primary account holder to complete online or by phone. Verify that the issuer reports authorized users to all 3 bureaus before proceeding. Simultaneously, pull your credit reports from all 3 bureaus and identify any errors, incorrect balances, accounts not yours, payments marked late that were made on time. Dispute every legitimate error through the bureau's official dispute process. If your score is between 650 and 720, this month find the statement closing date on every credit card you carry and set a recurring calendar reminder 3 days before each one. Pay balances to near zero before each closing date for 2 consecutive billing cycles, then pull your score. The utilization improvement will be measurable and visible. Also this month, request credit limit increases on every card that permits soft inquiry increases. Document each request and the outcome. If your score is above 720, the strategies still matter for the difference between good rates and excellent ones. The gap between a 740 score and a 780 score on a $350,000 mortgage can represent $20,000 to $35,000 in total interest over 30 years. Focus on utilization timing, periodic limit increase requests, and maintaining the account management practices that protect your oldest accounts indefinitely. Regardless of your starting score, review your full credit report annually for errors. Studies consistently show that significant percentages of credit reports contain inaccuracies material enough to affect scores and lending decisions. Disputing errors is entirely separate from the optimization strategies described here and should happen in parallel. 2 brothers, 3 streets apart, same lender, same month, $127,000 apart. The younger brother learned what his older brother knew. He spent 8 weeks implementing the authorized user strategy through their father, adjusting his payment timing, and requesting limit increases on 2 existing cards. His score moved from 681 to 744. He refinanced his mortgage 14 months after closing and reduced his rate by nearly a full percentage point. The $127,000 gap narrowed considerably. The credit scoring system was not designed to help you. It was designed to help lenders predict and price risk, and the institutions operating within it profit from consumers believing that improvement is slow, mysterious, and largely out of their control. That belief keeps people in high-rate products longer. It keeps them dependent on credit monitoring services. It keeps the revenue flowing in exactly the direction the system was designed to direct it. The strategies in this conversation are not workarounds. They are the system's actual rules, operating exactly as designed, accessed by the people who took the time to learn them rather than accept the simplified version promoted by everyone with a financial interest in keeping them obscure. I'm Zik. Patricia saved $215,000 on a mortgage using knowledge she found in 93 days. The younger brother closed a $127,000 gap in 14 months. That knowledge now belongs to you, and unlike a credit score, knowledge does not have a utilization rate. Use it completely. If these conversations are consistently giving you something worth having, subscribe. New content every week. Every video is built around the gap between what financial institutions tell you and what the mathematics actually say. The next one is already coming. Make sure you are there for it.